My goal is to go as far as I can with the tourism and hospitality, probably to master's level, and then to see how far it takes me in my career. That's about it.
Okay, good. Well done. Great. So, Chelsea, you want to introduce as well?
Yeah, hi, I'm Chelsea and I'm from Kent. I work full time at a university as an administrator, and this is my first course with UK Versity. I really into the travel and tourism and event management industry, so that's why I'm doing this course to hopefully prepare for a job in that industry once my administrator job at the university finishes.
Okay.
Okay, great. Welcome. So, my name is Anjum Satar. I'm teaching with Roman with UK University last 3.5 years. I'm in Doncaster College as well. I'm delivering BA, BM qualification, CMI, which is Chartered Management Institute level 5 to level 7, and AAT qualification, which is Accounting and Finance. My background is MA in International Business Management, MA in Marketing Practice, ACCA partly qualified, and PGCE. So today I'm with you. I'll try my best to meet your expectations. English is not my first language, so if you not get me, so please ask me. I'll try my best to meet your expectation. Okay, we'll start. So first unit we are going to start is a finance. I'm not sure. Have you learned finance before?
Yes, accounting and finance, yes. And then I did that
Elsie,
level
have you
5 as
learned
well.
before anything about accounting and finance? Hello. Hi, Chelsea. Have you learned before anything about accounting and finance?
No, this is my first time.
Okay, so I'll try my best to go through the very basic first.
Okay.
And then we'll go through in detail. But we are doing very basic accounting at this level because it's only one of your unit, which is accounting and finance. So we're not really preparing very detailed financial statement. Well, we'll go through the basic behind and why these financial statement is important in a hospitality business as well like other businesses.
Okay, perfect.
So this is your course content and the unit contents as well, which is unit 3, accounting and finance, level 4.
Yeah.
Guided learning hour, really we need to be learn around 80 hours.
Okay.
It's a 20 credit unit, mandatory assessment criteria, just only pass or refer or fail. And there are 4 learning outcome really we need to address. First is understand the function of accounting within the different type of tourism and hospitality organization, where we'll discuss about sole trader, partnership, and companies businesses, and how we can use financial information, which our discussion will be focused today. And then second learning outcome will be able to prepare documents involved in the financial transaction. So what sort of documents involve those we require to be record the business transaction. And then third learning outcome will be about just comprehensive income statement and financial position, and you will be in a position to be prepared these two statements, which I'll go through the layout of these financial statement, how we can prepare them. And the last learning outcome, understand how an organization should manage its fixed working capital. So which will go through the working capital. Working capital is mean the running capital of organization and how we'll manage these and all. So there are under each learning outcome we have assessment criteria 1.1, 1.2, 1.3, 1.4. Under learning outcome 1 we have 4 assessment criteria. Under learning outcome 2 we have 2 assessment criteria, and some 3 and 4 as well. So key topics we're supposed to cover: the purpose of accounting and finance function in a tourism and hospitality industry, then different type of tourism and hospitality businesses structure, which I'll go through with you, different sources of finance. So all these topics really we need to go through. And if these are the recommended book, Chelsea, especially you can get from library as well, university library. So basic management and accounting, hospitality industry, and are the accounting essential for hospitality managers. So all these are the books, quite useful if you want to do a bit, background reading.
Perfect.
Okay, any question?
Not so far.
Okay, brilliant.
So this is just a little less than what I would have done earlier up in the year in level 5 with you, Andrew.
Yes, most of the things are similar because you did level 5. No, you're doing level 4, even is a low level than level 5. So it's almost the same thing you're doing. Most of the things will be similar, which you just supposed to redo really, somewhere.
Yeah.
I'll discuss with Raman. Maybe I'm not sure you entitled exemption or not, but you can go through just assignment really. I will go through a bit debit and credit rules again.
Okay.
We'll start. I put a lot of stuff there, but I'll go through very basic today, and the next lesson we'll go through more in detail. So first our discussion will be today the difference between financial management and financial accounting. Then we'll go through what is the debit and credit. A lot of people have really thought about debit mean is addition, credit mean is a reduction something, or some people have a view credit mean is a addition, because we always hearing or we heard every day, oh, my salary is a credit in my accounts, so it mean increase in my accounts, the money, which we'll go through is a different concept. In a generic, we normally is a different in bank point of view as well, debit and credit our point of view as well. Type of ledgers, which we'll discuss, what type of ledger normally we prepare in accounts, and we'll go through the financial statement, how many types of statement we need to prepare in businesses, especially in hospitality and tourism business. And I'll not focus maybe today on ratios, but in the following lessons we'll go through the ratios as well. These called financial ratios. I wish on the end of the lesson we will be more clear some our thought about debit and credit, and we're supposed to be you will be in a position to and different financial system, financial control in place within your organization, and we'll go through financial management and how we can calculate these ratios. Okay. Any question?
No,
so if you have
I've got no questions.
Okay, please, if you have any question, ask me, feel free. Okay, let's financial information. What's come in your mind? Financial information, where we can get the financial information?
Financial information, well, we could find financial information of any company or business probably in publications, in papers. It's usually out for the public and other stakeholders to view.
Okay. So what sort of document really we need to review really to get the financial information? Any particular document you think which we need to?
Financial information, okay. We look at balance sheet, profit and loss account, cash account, those sorts of documents.
Yes. Well, then these are the financial statement provide the financial information. Every company, almost every organization, they prepare the financial reports. So either is a profit organization or non-profit organization. Some organizations for them is not a compulsory, like universities. but still they have to publish some sort of financial information, their financial budget, financial planning, internal document within our organization as well. These provide the financial information. It's crucial to be manage our financial resources within a business. Okay. And we have a always is good to know what is the difference between financial accounting and financial management. Any thought what is meant by financial accounting?
Okay, financial accounting. This is accounting that keeps track of a company's financial transactions.
Okay,
So
good.
they record it and summarize it, and then probably have financial reports and statements, and that's where we find the income statement and balance sheet. But this is just mainly for the company. Whereas financial management, they go a little further with planning and organizing and directing and controlling the financial activities, and well, as stated before, they publish it for other stakeholders to see.
Okay. Financial accounting. Yes, you very well said, very well mentioned. Financial accounting mean is a systematic record of business transaction within a book of accounts. So systematic is like debit and credit rule. What is a debit? What is a credit? Where these statements goes, like if we have an income, if we have an expense, supposed to be in a profit and loss account. And if we have asset, it goes to the, normally we record under the financial position, or we call balance sheet, which I'll go through for the slides with you. Okay, financial management is the word is a management. So what is meant by management? Any thought what is a management? What is meant by management? What's come in your mind, management?
Is that where they plan and budget and organise? They have responsibility for the overview.
Brilliant. That's that's a management where we have a responsibility. So when we are talking about the financial management, so we're looking the finance, where you got the money from, how much you spend it, you are responsible of your fund. So like making a budget, like each in university as well and various other organizations, we have a budget. We are responsible for it. And financial management is come all, the management activities within our organization. There's no time scales. So big difference between the financial management and financial accounting. Financial accounting, we have a rules and regulations. We have accounting standards. Those, and for the companies, it's compulsory to prepare the financial statement within 12 months. After every 12 months, we have to prepare the financial statement. Okay. How many types of financial statement we prepare in accounts? Anybody, any thought? Yes. Chelsea, have you heard how many normally prepare financial statements?
Is it once a year you have to prepare them? Do you have to do monthly ones as well?
Yes, monthly we can do internal reporting. That's come under the management accounting or financial accounting.
Yeah.
Sorry, is a financial management, but financial accounting normally 6 months or yearly. But yearly is a compulsory. Sometimes they prepare the mid-year result. Some company they prepare the quarterly result. But by law they are compulsory. They must have to publish their account after every 12 months.
Okay.
So the financial statement we prepare is a profit and loss.
The balance sheet.
Balance sheet. Cash flow statement. And one other statement is called equity statement or shareholder statement. So these 4 type of statement these are compulsory for companies. Those are limited companies, public limited or private limited. They must have to publish these statements. Okay. So primary user under the financial accounting is external, but management accounting or financial management is all about internal. managers of business are implied they use that information.
Okay.
Purpose of information help invest creditor. Time scale is always, we look around the historical data, the data of the previous year, but under the management accounting, current and future more focus. Gaps, these are is called accounting standard, which is general acceptable accounting standard, are different standards, stock exchange and various these standard, regulate. But normally under the management accounting or the financial management, there is a no standard particularly apply on them. So objective accounting financial statement always auditable, is reliable, consistent and precise. But management accounting or financial management is more subjective judgment what will be happen in future. So just, more concern, highly aggregated information. So this is a bit, different. So it's, you don't need to be memorize everything, but is just, give you how now what is the difference between financial accounting management or the financial management
Mm-hmm.
or the cost accounting. Objective, of course, we provide the information. Both these sort of, all these accounting, either we call cost accounting, financial management, or financial accounting, these provide the information either internally or externally. So financial accounting we prepare, but them provide the information to the external user. So like a shareholder, external user, creditors, financial analysts, government agencies, HMRC, they require, these financial statements to charge the tax, from the companies. And the cost accounting, which we just, how much cost if we are making product, and we are launching any new product, if we are running any course, how much is, we do cost and benefit analysis for it. So time scale normally is a 12 months for financial accounting, but there is a no time scale really, it could be earlier or later. And this normally is a proper format for financial accounting statements, not for cost accounting, financial management. Different layout companies adopt, keeping in view of their requirements. Okay, any question?
No, not so far.
Okay, let's, next the purpose of accounting systems. Why? To ensure all transactions are correctly recorded and can gather together for a period in order to prepare the set of financial statements. So accounting system we prepare, we adopt or we implement within our organization to record the business transaction. Like, some people working as a bookkeeper in a business in accounts, so they record the business transaction in the book of accounts. Some people working in sale department, some people working in the purchase department. In various organizations, they keep the record of transactions through systematically way. So transaction, what is meant by transaction? Any example of transaction?
Is it when you purchase something and you're paying for it and then it's transitioned from one account to another?
Yes, brilliant. So that's called one transaction. You purchase a furniture, and that furniture is we have paid against it some money, or we will pay in future. So that is called one transaction. And that transaction we need to record in the primary document, like in our purchase book, as well as our asset register, because buying, furniture is our asset, so we need to be registered. We need to record our transaction in the proper systematical way. So accounting is mean record the business transaction in the book of accounts through systematical ways. So there is a system of debit and credit. Okay, these all the transactions: cash sales, credit sales, sale return, receipt. Primary document, we prepare the sales invoices, credit notes, remittance, checkbooks, purchase invoices. All these are the primary document. Then we have a primary books where we record cash book, where we record all the cash receipt. Sale day book, we record all the sales. Sale return book, we record all the return. Purchase day book, we record all the purchases. Are we aware of petty cash? What is meant by petty cash?
That is a small amount of cash that is used for small expenses throughout the day.
Brilliant. So every organization have a petty cash book where we can say, we put it 2 or 500 pounds. So if within a department we need like a printing paper or anything we need to buy, we can withdraw their money, or we need to buy tea bags or various things, like a little stationery, we can buy our own instead of central department will buy for us. So that's called petty cash, normally in our organization. Journal is where we can record all the transaction, not in a books but in a journal. It used to be manual journal in the past, but now we have a Sage accounting or various other accounting software where we record all the business transactions. But in the manually we used to call journal, big sort of books, where we used to record the transaction in the book of accounts. Any question?
No.
Okay, so these are the general ledgers, or we also call nominal ledgers, sale ledgers, purchase ledgers, where all the sales, all the purchases will be recorded in those accounts. Okay. In a business, each transaction have a two effect. Either will be debit as well as credit. Every transaction will be dual effect. So if I'm doing debit something, I should do the credit something against it. That's why we call double entry bookkeeping. Two entries. When we buy the furniture, so furniture is our asset. Asset is coming. If we are making the payment against it, so the cash is going out of the business. So furniture is a debit, cash is a credit. I'll go through in the next slides as well. Assets always asset equal to liabilities plus capital, or we can call asset minus liabilities equal to our capital. So this is called accounting equation, which is like in math, your right hand side equal to your left hand side. So always debit side on the left hand side and the credit is always on the right hand side. So normally we call debit and credit. Okay, this is we use the word debt click, which is mean the debit is mean anything increase we call debit, like expenses. If is increase we call debit. If asset is like furniture, machinery, cash, anything which give us economics benefit, like if we have a furniture in a business that give us, we can use for the business activities. Building, land, books, depend nature of the business, all these are our assets. Advertising is our expense. What is meant by drawings? Anybody ever heard drawings?
No, I've never heard of it.
So drawing mean any money you draw for personal use, business. That's called drawings. You invest it, but you draw something for your personal use. That's called drawings. So which we always do debit. So D stand for debit, E stand for expense, for asset, D stand for drawings. So when these all increase, we always do debit. When these increase, we do credit. Opposite of debit is a credit. Okay. Next now, credit side increase in liability. What is meant by liability?
What you owe.
Yes, liability mean what you owe. It's called legal obligation. As a company, we have a legal obligation. Like, credit card, we owe money on it. It's a liability for us to pay back to the bank. Yes, it's a legal obligation. We are legally obliged because we have signed a contract with a credit card provider. So it's called liability, and liability is. So if we are increasing our liability, we're supposed to do credit in the book of accounts. Income always credit, like we always say, you know, when your salary credit in your bank account, it's mean your money is increasing it, and we do credit, and we do income credit as well. Like, you know, the sales is a credit. Capital, what is meant by capital? Any money we put in a business, we do credit as well. So when we are investing any money in a business, we call capital as a credit, and we do asset as a debit, because cash is goes in the business, that will be debit as a cash, and credit as a capital.
Yeah.
Any question?
So does debit equal cash and then credit equals
Capital.
capital?
Like if you're investing £100 in a business, so £100 cash will be debit in your accounts,
Yeah.
and £100 credit will be as a capital investment in a business.
Okay, yeah, perfect.
So that's a debit. What I'll do, I'll send you some activities. You know, I have a separate double entry bookkeeping activities.
Yeah.
So when you go through, that will make you more sense, you know.
Okay, thank you.
Okay. When we make financial plan or financial planning, we look always, you know, we look around the balance sheet, cash flows, income statement, budget, break even. So these sort of the things, you know, we always look around when we'll make any financial plan. Okay. I'm not playing this video. I'm skipping. I'll go through next now. Increase asset is a debit, and decrease in asset will be credit. So when I'm decreasing something, I'm credit. So against the, because of course, if I'm in a credit, I'm doing something credit, I should do something debit as well.
Yeah.
Because both sides, you know, then will be equal, otherwise won't be equal. So because double entry bookkeeping. So this map will help you as well to differentiate. Liability increase is a credit, but when I'm paying off my liability, I owe something. When I pay off, it means I'm decreasing my liability. When I'm paying off, I owe money. I bought a furniture, but I didn't pay the money. So the furniture is a debit, furniture is an asset. The company which I borrow or not paid them, I bought the furniture, that company I put as a credit. Furniture as an asset debit, that company's name I can put as a credit. And I'll pay off that my liability, I'll do debit that company, or like, you know, which furniture company, SCF or any other furniture company, home based store for suppose, or Argus, I bought furniture from Argus on finance, is credit. In future when I'll pay, I'll do Argus debit and I'll do cash credit, because cash is going and the liability is decreasing. Yes. So debit and credit. So don't take too much, you know, really stress about the debit and credit. When we'll do few activities, that will be make you more sense, you know. Okay. So this is a accounting equation. Asset is equal to liability plus capital, but always equal to income minus expenses. Yes. When you take out expenses, that become your profit. Okay. This is trial balance we prepare always in accounts. Trial balance mean our debit and credit side both will be equal. It means trial balance mean both sides should be equal. So this is one of the ledger. Ledger look like, you know, this is my receivable. Receivables mean the money which I have to receive from our customer. We can look around. I have my receivable 10,000 due to sale, because I made credit sales 10,000 worth of, and in a future date I have received 2,000, which is in shape of cash. So how much is balance still I need to receive is 2,000. So this is a balance carried down for next period, and the next period at the start of the month or the start of the week or the start of the year, I'll say balance brought down and carry forward or carried down. That's a closing and opening balances. Does it make sense?
Yes, it does.
Okay. This is all about the debit and credit. Let's will move next now. Accounting concepts. So we prepare, like I discussed, we prepare how many types of statement? Four. One statement is called profit and loss, or some people call income statement. It's the same thing, no difference. Profit or loss or income statement is the same thing, just a words different.
Yeah.
And balance sheet or the statement of financial position is the same thing. So in the profit and loss, where we shows how much sales we have, how much is the cost, how much expenses we have. And in the balance sheet, we always show how many assets we have, how many liability we have, how much capital we have.
Yeah.
I will show you some company's financial statement today that will give you more idea. Okay. Like a profit and loss, it's also called income statement, statement of comprehensive income. We always call sales, revenue, or turnover. These are the same thing, same words interchangeably we use. We'll carry on using different words, for sales. Any question?
No.
Cost of sales we can calculate. We can use the formula. Opening inventory, it means opening stock plus purchases plus carried inward. What is meant by carried inward? Anybody ever heard?
No, I haven't.
Okay. Carried inward is just a delivery cost, delivery charge. When you purchase, like we purchase furniture, they said, the furniture company or like Argus, they said, no, we'll charge £50 delivery charge. So furniture cost us £500. The delivery charge carried inward is mean we bought something came inward. Like, call center, inbound call center and outbound. What's the difference inbound and outbound call center? Like, in our organization, we have an inbound call center and outbound. Inbound mean the calls coming in, outbound we can call them, our customer. So carried inward means something came in within our organization and we paid the carriages. Carriages mean the delivery charges.
Transportation cost.
Is it clear?
Yes.
Which is also transportation, the cost for transporting the goods.
Brilliant. That's a transportation cost, other way around. Purchase return is anything we bought, we are returning. That's not good. Maybe the good not fit for purpose. Okay. Next. Expenses, rent, wages, salaries, insurance, and other income could be discount received and things. Yes, disposal. And the financial statement, like a profit and loss, should look like this. Sales revenue, less cost of sales, opening inventory, purchases, less closing inventory. It's become a gross profit. Then we take out all other expenses like rent, wages, bank charges, then we get the profit for the period. Does it make sense?
Yes.
So this is just a layout, which we'll do proper, activities. We'll do extra lessons, we'll spend more time on it. Okay, next now, balance sheet. It's come all assets. Assets is the machinery, furniture, cash, prepaid. What is meant by prepaid?
Paid in advance?
Yes, paid advance. Prepaid, we paid advance. Like, insurance company, we pay whole year premium. That's called prepaid. If we're not using the services or we're not getting, like we paid 12 months and we sell our cars, prepaid money we can get back. because still is our asset. It's not became an expense. So that's why we'll put in a balance sheet. So we have two types of asset, non-current asset and current asset. Non-current asset mean the asset we can use more than 1 year. Current asset mean the asset which we can use within a year. Debtors mean the customer, those owe our money, we need to receive from them. Inventory mean our stock.
Yes.
Capital is our investment. We have two types of liability in a business. One is called current liability. Anything which we need to pay back within a 12 months is called current liability. Our short-term liabilities. And non-current liability mean the long-term liability which is we pay within, like bank loan, we can pay within a mortgage, bonds, which we can pay more than a year's time. And balance sheet layout is look like this: current assets, current liabilities, and we have a net assets, capital. So normally it's look like this way, you know, the statement of profit is the balance sheet. Any question?
No.
This slide will explain you as well. Current asset, what's come under it. We have a different accounting standard. Those regulate the things, you know, those provide, you know, which way we can present. I'm not going through, you don't need to be, but I put it the slide for the sake of information. Okay, all accountings are the financial statement. Anybody heard about going concern? What is meant by?
Going concern, no.
It means the company will carry on the business as a normal. You know, when we'll prepare accounts or the auditor do audit, they always give the statement that this business will carry on as a normal business for unseen period of time. Accrual, always we saying cost incurred in earning it. So we always comparing accrual, we compare income against expenses. Accrual concept which is called matching, debit and credit. Prudence, prudence is mean the check, you know, when we'll make accounts, all the financial, like, you know, the Tesco manipulate the profit. They said, you know, they make the profit 220 million, actually profit was 160 million. So they manipulate it. So when is a prudence mean it should be true and fair. There won't be, yes, prudence mean is a caution amount is used where is we say is a true reality. Consistent, every year, you know, we can look around one layout, consistency. So when will give 1 year figure, that's why the financial statement always show 2 year figures. That's why we can say what's happened last year figure to this year, is increase or decrease. Okay, always financial statement need to be relevant. Relevant means this period, you know, within 12 months that transaction shows. Comparable, we can compare this year to last year figure. We can verify if the company say we have a 20 million worth of asset, they should have, they're not written just in statement. Faithful is mean true and fair, everything true, which is matched with the reality. Understand, the figure should be understand is a timeline, should be within a 12 months, because every 12 months we should prepare. If one time we'll prepare 18 month statement, next time we'll prepare 6 months, that's not a comparable, that's not understandable. So we should have a proper consistent system. These are the rules really.
Okay.
Okay, can I just quick, you know, if you don't mind to pick one. Hello.
Yes.
Yes, I'm coming. Okay. Okay. Just closing. Okay. Okay. Sorry about it's just one urgent call. Okay. So next now, as a manager, if you're working in a hospitality industry or any other industry, we need to be look around as a financial. If you're a manager, you are responsible of manage the financial statement or the financial information. Does it make sense?
Yes.
of the day, is a finance, all about the business. So this is, as a managers, we have a responsibility to record the transactions. Basically, we don't need to be if we're working in hospitality industry, we have a cash book where we can record all the cash transactions. And we need to put the control in place, really all about. Okay. Next slide, which is one of our learning outcome, which we need to go through, is called, what is the difference between sole trader partnership? What do you know? What is meant by sole trader?
Is a sole trader an individual that owns a business, whereas a partner is a couple of people that own a business, but you could have distant partners so that aren't really involved in the day-to-days of the business, but they're involved in the bigger things. Then you have the partners that are involved in the day-to-day of the business running.
Brilliant, well done. So partnership mean more than two people involved. So sole trader, it could be corner shop, one person own everything, yes?
Yes.
One person is responsible own investment, one person is responsible. In a legal form, there is no really law. You can start it whenever you want to start it. Depends nature of the business, yes? Some business maybe you need a license from local council to start a business. But sole trader is otherwise, is no requirement. You can start, whenever you want to be, as long as a legal activity.
Yes.
So capital contribution is individual unlimited liability. If we earn the profit, we bear the loss, everything will be our own.
Yeah.
If we have a loss, if we borrow money from the bank, and we have our own house as well. If we not pay back, they can claim against the house as well. Because unlimited liability. But in a partnership, we can share liability. It could be unlimited liability up to our investment. Or the partner can share. There is a proper Partnership Act 1984, which is regulated, which is being amended under the Partnership Act 1961. Further is amendment. So that is regulate, everything. Yes, what is our profit sharing ratio? We should have a written agreement between, how much, like you will get 20%, 30%, or various other. So these are the difference between partners and sole trader. Then we have two types of companies in a business. You can start business as a sole trader. You can start business as a partnership. Business as a private limited company or public limited company. What is the difference between private and public?
Private is privately owned by individuals. Is public more to do with the government, and it could be government owned or government have influence within your business?
Yes, normally the public limited company, the public have shares in a business. Anybody can buy the shares and sell the shares. Like Unilever, Procter and Gamble, like Sky, Media, all these are public limited companies. The private limited, we come together, we can register the company in a company house and we can start a business, but we're not selling shares to the public. We're keeping as a private investor our shares. And we have a limited liability up to our investment. Nobody can claim against our house. And if we want to start a public limited company, we must have more than £50,000 worth of investment first. There is a lot of legal requirement. We must need to be memorandum of article association, how much shares, what percentage shares, how often, stock exchange, we need to be registered, we need to apply a license for it. We should trade in the stock exchange our shares. But the private limited, it's not a compulsory for us. Does it make sense?
Yes.
Yes.
Okay, that's the big difference between. Okay. Any question?
No.
question.
Okay. Can we do quick, quiz on debit and credit?
Sure.
Okay, we'll do quick quiz. It's not a quiz, it's a sort of, develop our understanding, yes?
Okay.
I come on, sorry. My typing errors. Okay, we'll go through this one. Okay, it's a just, we'll go through very basic. Please, can you type Kahoot it, please, in your search? Just type Kahoot it, and the little window will be open. I'm giving you pin number. Okay, that's the pin. You can choose nickname. Yes, Chelsea, are you there? Hello?
Hello?
Yes. Have you managed to log in? Just type Kahoot it, and this little window will open.
Sorry, I'm just trying to load it.
Okay, no problem. This is easy for you. If not, we'll... If difficult, I can send you the link,
I'm just going to try and access it on my phone because my laptop's being a bit slow.
Oh, yes, you can do with the phone if you want. Okay. If not, we can play next time. That's fine. That's not an issue. Okay, that's fine. I think so. What we'll do, we'll leave it and we'll do proper, the quiz next lesson then. Is it okay? Okay. Don't worry. We'll play this, the Kahoot quiz next lesson. Okay. We'll recap what we learned up today, and we'll discuss more. Oh, you're there now. Okay, let's do few questions. Okay, what are the 4 parts of integral ledgers? I don't know, but just guess it. We discuss about purchase day book, cash book. What are those? Think just just a guess really. I need to go through more details. I just give you the. Just pick the right color, whatever color you want to. Your screen is supposed to show the color, and you need to see on my screen. Don't worry, just pick it. I'll just. Okay. The capital T account is a main ledger should be. We learn about capital should be debit or credit. Debt click. Which we learn. Capital balance. Don't worry if you can't, just tick any color. That give you idea. Just we learning for the sake of ideas. Okay, asset. We said debit side. Asset always. Just Chelsea, click the color. It is debit.
It doesn't say any writing. It's just got 2 colors on it. Do I just pick
Yes,
one of
yes.
the colors?
You just click the color, which is like red color.
Okay.
It won't show you there. It's only show you color there.
Okay.
The sale, we said sales is the income. Income always goes on the. We said debit and credit income when we said profit and loss. We said income minus expenses equal to. And which statement is it profit and loss or is it profit and loss? Shows the profit or loss? Yes. Well done. Great. Good. Now you're picking now. Okay. Accounting equation: assets minus liabilities equal to capital. Which statement? Which statement show the asset liabilities capital? Well done. Great. Good. The cash book is a combination of T accounts and the bank accounts and the payments. Yes, which shows everything. Don't worry, just pick it. I'll go through proper. Just the sake of cash goes on the debit side or the credit side. Next, all credit customer individual accounts are held. Customer, yes, credit customer, which sales we do credit, then we have a credit customer, otherwise we don't have a credit customer. So it should be sale ledgers. Which one ledgers? Purchase ledger. Our customer comes when we're selling something. Well done, great. A credit customer is also called. We said we learn about trade receivables or debtors. The customer, they will owe our money. It means trade receivables. Yes, yes. I think so. We not learn really. Personal payment discount day book or prompt payment discount day book. Okay. Well done, great. So it's quite good. Well done, great. So because we didn't, we not learn everything, but we just, played at the sake of, So a bit, debit and credit. I'll send you some, the activities to just recap. So today lesson we learn about how many type of financial statement we prepare.
4.
Those are
Profit and loss, balance sheet, cash flow, and equity statement.
well done. And we learn about debits equal to credit. And we learn about difference between financial accounting and management accounting or financial management.
Yeah.
So what is meant by financial accounting? These financial statement under which accounting system we prepare? Management accounting or financial account? Under financial accounting. Well done. And we learn about accounting equation assets equal to liability plus capital, or asset minus liability is equal to capital.
Yeah, assets minus liability equals capital. Yeah.
Brilliant. Well done. Great. So I'm going to send you I'll send you email with 2 companies financial statements, which is Marks and Spencer and Next. So please just look around. Yes, there are all 4 statements there. Just look the figures, which will go through next lesson.
Okay.
If you go through these, is the income statement there and the balance sheet there.
Okay.
And the next as well. Then we'll go through more, discussion about ratios and all others. You don't need to be worried because you're not going to really prepare. We'll try to prepare at least, 1 statement to learn the layout of it.
Okay.
That's be our learning outcome. Okay, so we'll keep up to here today lesson, and next lesson we'll go through further. Any questions?
No.
No questions.
Okay, have a good weekend. So please, if you have any concern, any question, drop me email. I'll go through with you.
Thank you.
And just go through these, financial statement and go through the slides.
Thank you very much.
Okay, have a good weekend.
You too.
Good night.
Yeah, thank you.
Thanks.
Bye.
Bye. And I'll send you the recording as well, please.
Thank you.
Thanks.